Welcome back to another Market Insight Call, joined as always by Aaron. Today's October 15th, 8 a.m. Government's still shut down. Probably a good place to start.
Yes, it is. I'm in agreement with Schiff. They opened them up too early.
I thought it was you who tweeted this, which is the government's shutdowns, they never shut down enough and they always reopen. And while he's joking and having fun, he's a big anti-government guy, the market agrees with this. They're going to always look past these because they do always reopen. And we largely agree with that. We didn't even write a blog on this. Typically we do to get in front of big issues, but we didn't see this as a significant issue. That's not widely agreed upon. Some big macro guys, I took Bob Elliott for example, who thinks this is different because there's the token of trying to get through this is maybe the Republicans want to start laying off people in the government to get Democrats to come to vote through on the Senate bill.
I hope it is different this time. I'm listening to the Effective Executive by Peter Drucker, so I feel like I'm on good standing on this, that most of the government agencies were created for a problem, and about a decade later that problem no longer exists, but the bureaucracies and the policies do, and they need to be updated. So if we get a little bit of a cleansing, I don't think that's horrible. For the government. There can certainly be an impact in the short term on the economy because there would be increased jobless claims, et cetera. But I view that as kind of like a chemo treatment. It's hard on your body, but if there is a problem there, it can cleanse that out, and long term it's better. So
we've been consistent on that since the beginning of the year that we thought that would be a theme of this year, and it hasn't happened to the degree that we originally thought. We thought there'd be more government layoffs, but at least there have been some, and our view that it would not hurt the economy also has played to not hold because the economy's been strong. And here's one of the reasons why the market's looking at this. One of our favorite charts from the left to the right. It's start of the shutdown, the reopen date, how long it's been going on. We're already at twice the average. Average is about 8, and we're at 15 today. Maybe by the time this is open, the government could be open. Who knows? The S&P 500 average return while the government shut down, basically flat. There's really nothing to take from that, right? You're not going to do anything. You're not going to panic. There are a few periods where there are small losses, but generally the losses come before as they see that the government is going to shut down. And that's what we did have. It's like 1%, little pullback right before the government, hoping that there wouldn't be a shutdown, and then there is. Little pullback.
So, they talk a lot about tariffs right now in the headlines, and I see the word taco, or Trump always chickens out. Maybe it's a GACO, government always chickens out on these things as well, so no longer trade it.
No longer trade it, and then the long-term average return, about 12% after the government reopens. There's nothing to trade off of here because it's pretty average.
Maybe we can mess around and get guac out of that. I don't know. Okay,
you're trying to be too edgy today, which is good. I love it. The other big headline is cracks in the credit market. So far, earnings have kicked off. Banks report first. We'll get to that. But the big news was a couple big bankruptcies, Tricolor and First Brands. And this chart goes through the other ones that haven't made the headlines as much. Saks and an energy company, NFE. I don't think we'll spend too much time talking on this about companies like Saks or energy companies. It's common.
I think the big question is it systemic or is it just issues with companies? I mean, it shouldn't be a surprise that Saks is struggling. And with interest rates as low as they are, of course, there's a lot of companies that were not viable that were able to prolong. And now that interest rates have been up for a while, I think you should see a clustering of some companies not doing well. And that's just part of the creative destruction that's necessary in a free market. I think the thing that you really got to pay attention to is just how is the money markets reacting? What's the yield curve doing? And I'm talking specifically on what are the banks paying on deposits versus what can you get on the 10-year to see if this is actually showing up to something that's going to be contagion and go through the system and be systemic, or is it that we just have some business models that are no longer viable?
Yeah, and that's going to be happening more often now. With AI, or you could use Saks as an example. Obviously, we have no exposure in our portfolios to Saks, but some people thought there'd be a turnaround story, but they were paying really high interest rates on that. But we're going to see more of these businesses. I think we're in a credit cycle where defaults will rise, but not to be some systemic issue.
There's
just a normalization. Yeah. This is what happens. There's always a delay after rates have increased, and we think rates will come down, not significant enough to save some of these poor businesses.
Right. I think that we do have a disruptive force going on in the market. We also have higher interest rates than we did before. I think this is normal and to be expected. Once again, the question is the viable companies, the ones that still have good economic models, are they going to be impacted?
I did want to hit what happened, because a lot of people were getting this wrong and just saying it's all private credit funds. And sometimes the asset-backed loans get categorized as private credit. But for the most part, these were in syndicated loans or the leveraged loan market. JP Morgan had exposure to Tricolor, right? And the fantastic lender with a great track record. And they even talked about it on their earnings call yesterday, where CEO Jamie Dimon, who Wall Street loves to quote him, said he thinks there will be more of these. At the same time, they were reducing their expected credit loss as a firm. So they're saying, yes, we're going to see this. It's normal to see this, but also the credit environment looks pretty good to us still. And the other side, First Brands, that one, both of them have hints of fraud, if you want to call it that, where they were double
Financial
pledging,
engineering.
triple pledging their receivables. And when you have the rate environment that you described, you're going to expose fraud as they're not able to keep paying these.
Right.
But the earnings reports from the banks, we pulled this together so far. We throw BlackRock in here just because it's an earnings report that happened yesterday. JP Morgan, Goldman Sachs, Wells Fargo, Citi, all great revenue, great earnings reports. The banks look really strong. So what you said when you're looking at how's the loan growth from the banks, how is their credit look from a early signal, because these, going back 10 years ago when we were trading with Ted, and he would talk about he used to always look at the banks as that early signal for economic activity. They look good.
That aligns with what we were saying on just pay attention to the money market, right? That's what banks are doing. They're in the money market, so if problems show up there, it's going to show up on their earnings first.
Exactly. I pulled this slide. It's Bank of America survey of fund managers, because I think it's a great catch-all of hitting, when we talked a little bit about systemic risks. On the far right of this slide, we'll just go through them. Source of credit risk, credit event. Crypto was stated as one. Very, very small answer. Do you follow the market of crypto much?
I know what's going on in the world of crypto. Crypto is the latest Beanie Baby craze. I do think that there's some legitimacy, especially in Bitcoin. There's correlation, not causation. Like the problems that are going to show up are not because of crypto, but they are going to align with an easy money environment. You're going to see crypto take off. If we go into a less easy money, you're going to see that some of that speculation, which is what's happening in the crypto markets, the amount of leverage that's being used to try to gain access to it. So a correlation, no causation whatsoever.
I don't follow it, and like you said, I separate Bitcoin out from the rest of crypto, and even really Ethereum. Some of the ones that actually are being used versus the dog coins and cat coins and the president's own meme coin, which get thrown in this example. And on Friday, we'll talk about what happened with some of the headlines with China. I didn't really appreciate the leverage in the system of crypto. A lot of these guys got completely wiped out, trading on 10 times leverage. Cryptos go down 10 to some of them 50+% just in a quick wipeout. Accounts were completely washed. Now, stocks were down 3%. I don't think it's because of crypto, like you said. Maybe it had a small impact of if your crypto portfolio blew up. A lot of those guys probably didn't even have stock portfolios. Right. So there was no systemic risk when we're looking there. Brings us to treasury markets, which the whole world is trading off treasuries as collateral, and there is a source of that being a credit event. To me, I don't think that's anytime soon.
I don't think it's anytime soon. I think we got gold on here. There's a lot of interesting things going on. We have the tariff trade and the headlines. And a lot of companies, a lot of countries are doing China plus one, meaning they're trying to find an alternative source to China as a manufacturing component because of COVID and all the things that we've talked about for the last 5 years of offshoring and de-risking your supply chains. That same phenomena is happening with the US dollar. I don't see anyone beating it long term, or at least in the near term, over the next decade. But as of now, because of the price of gold and because people are trying to find alternatives to SWIFT, the central banks hold more gold reserves than they do treasury reserves. So there's a lot that are going on here underneath that we've talked about for decades on the need to hold cash and hold gold as this whole new regime of what the future looks like is beginning to slowly play out.
And that long gold trade was cited as the most crowded trade. Kind of goes with the anti-dollar trade, at least historically. When the dollar is down, gold is up. It's been so strong lately that there are days where the dollar's up, gold's actually up, correlated with even Mag 7 too. Mag 7 will be up, gold's up. And the most interesting part of gold to me was Friday, which we'll talk about again. The market pulled back where gold was strong. And then as some of the tariff fears went away on Monday, gold was strong again too. So you're getting it, just a complete strength in the asset.
I think you got to say too far too fast with gold, and I will caveat and say that at the beginning of the year I took gold as one of the best performing assets for the year. I did not expect this type of performance. It gives me pause. I don't want to sell gold, but I think that it's gone. It's an overcrowded trade at this point.
But give me. I don't want to steal your theory that you've talked about for a long time and pretend like it's mine. You've talked about how gold markets take time, they catch up, they move. So is this just a catch-up trade?
I do think that gold has been unloved for a long time and needed to go up. Part of it is because the newness of Bitcoin and as its performance, I think that took a lot of components. There was also a big run-up post 2008. I think it was like 2011, 2012, where gold and silver spiked dramatically and then went into a bear market for quite some time. So some of the jitters are still there with the gold, but I do think that this isn't necessarily that there is something happening right now to drive gold. Gold is just catching up to where it should be. And I do think long term it's going to be higher than 4,000. I just think that this run up has been really quick and it needs to cool down for a little bit to be a healthy market.
And to close out the sources of credit event, private equity, private credit is getting a lot of headlines. The growth in private credit is saying they came in or a little. And there's regulation reasons why the banks can't fill that void, but they're coming in very competitive, lending out money at too low of interest rates than they should be. They haven't had much in losses. They're probably going to increase. And the question is, does that lead to some systemic event? Again, I think it's not going to be a massive systemic event. It's going to be a normalization of their loss rates are under 2%. That's going to go up.
Well, interest rates have been too low for too long. And ways that people were trying to reach for yield was these products. And there's a lot of money chasing too few of options. So yes, things got overbought, but there's still a lot of money that's trying to find a place. So I don't see it, without a pullback in the amount of capital available, I don't see a systemic drop.
In a good example that might be cherry picking, we don't allocate to private credit, but we do have a few allocations to private equity. And the point of saying it's not systemic, the first brand's blow up, Apollo was actually set up in their hedge fund. It wasn't in they didn't have a credit exposure. One of their hedge funds was set up a facility to short First Brands, which is expensive to short a private business, but they did that and were aware that there was something with this company that didn't look good to them. But at the same time, they're having issues with another headline of BDO, a company who they have a lot of units, but obviously some of it is tax and accounting. And that's a place that could be disrupted, going back to what we said earlier.
The algorithms on how to just do tax and accounting, AI, that's going to disrupt that industry for sure. When we've added Gatewood Tax and Accounting here, and when we look at the amount of revenue per full-time employee, it's half of what the wealth advisor component is. Now, CPAs are very skilled. We're equal, if they're not better skilled than we are in things. So the reason is like, what value can they bring? It's so algorithmic, which is going to lend itself to the AI disruption. So I do see that as another component of, no kidding, these companies are having problems.
And the biggest tail risk, we spent a lot of time last month actually talking about Fed independence, that we're kind of different than the rest of the market, of saying they've never really been independent, and we don't see that as a huge tail risk. But the other one that we didn't spend a lot of time talking about is the second wave of inflation.
Yes.
Which is, we've seen it tick back up in inflation. Nothing substantial, we're not worried about it. It's just when we talk about what could come, I think we're going to pencil in 2 more rate cuts for the year. Puts the Fed in a good spot where their Fed funds rate is still higher than the inflation rate by some margin. But if the inflation keeps ticking up, the story of 2026 might be the second wave of inflation. Does the Fed have to then take back some of those cuts and actually increase rates 1 or 2 times? And that could slow down the market. I think that's not going to happen at the end of this year. So the story will still be rate cuts, but I think we'll shift our discussion on that into next year.
Yeah, so I would say two things on that. I would not want to be where the Fed is. I think they're in a situation that's difficult with, one, they don't have great data with the government shutdown because some of the data feeds are offline. There does seem to be some issues on the broader economy that says to cut rates, but then we do have the second wave of inflation coming in that would say we'll keep rates at the same, maybe even raise them. And then the second part is that inflation comment, because we were on record saying that the tariffs would not be inflationary because inflation is always and everywhere a monetary phenomena, and we were in an environment where the Fed was not expanding their balance sheet as they were raising rates or keeping rates high. That seems to be changing. So to your point on the second wave of inflation, tariffs or not, they don't help the situation. But if the Fed is becoming more accommodative, I do see inflation coming back.
Money supply growth is about 1%, 1 percentage point below its long-term average. So if we start seeing rates come down a little bit, bank lending, opening up, deregulation from some of those banks, we will see that increase. And the other thing that helped markets actually recover midday before Trump started tweeting at the end of the day was Powell was giving a speech. Now, we don't pay too much attention to it, but it does for the next few meetings because he'll no longer be chairman in beginning of next year, towards the beginning of next year. And he said a couple things. One, nothing's really changed since our last meeting. So that's basically green lighting. The last time they said there'd probably be 2 more cuts at the end of the year. That's probably going to happen. And they've been rolling off their balance sheet. He said that probably needs to stop too, which is that was a source of pulling money out of the system.
Right.
He saw some tightening in the system. That was their goal of doing it, right? So he's saying we're going to stop doing that. Well, that's bullish for money supply growth. Exactly what you just said.
So if our call at the beginning of the year was inflation is probably not a big deal going forward, I would say our call, if this is what's going to materialize, is inflation is going to be back as an issue that we're going to be dealing with in the headlines.
And we historically bring on some of the macro guys at Wisdom Tree. Jeremy Schwartz at the beginning of this year predicted that we would see headline movement in the stock market from President Trump. And I kind of dismissed it at the time of, man, the market's done this before. Well, he was right. We're seeing him moving markets with his tweets. It'll be interesting to see if now they've changed their tone, as Jeremy Siegel, professor from Wharton, is going to come on in a couple months, talk about 2026. It'll be interesting if he agrees with us that it's going to be back to a little bit of monetary as we move past some fiscal.
And that's a good reminder. If you haven't done so, make sure you subscribe so you get a notice that we're having these guests on. Share it with your friends because these guys do really know what they're talking about. And make sure you like that if you enjoy these guests. If you're joining us for YouTube, great, keep visiting. But if you like to listen to your car and Spotify is easier, why don't you go ahead and download Spotify and subscribe to our channel because we are streaming on Spotify as well.
You said taco earlier. It's something
I did.
we've avoided. I don't like grown men saying taco. It's just kind of a silly acronym. But what is it?
Trump always chickens out. So the idea is that when Trump is hitting these headlines and doing things that which moved the market earlier in the year, it's not having as big of impact. So people have already taken into consideration, people would say, well, this is how he negotiates. Yeah, that's the point. Everyone knows how he negotiates now. So they're not taking this as seriously, knowing that he's moved the bar very far and he's going to pull it back. So I don't see a lot of the volatility from his headlines that we did previous, barring there's actual some substance to these tariffs.
We went months without it, right? Ignoring it, but things were going well. And Trump tweeted on Friday, as some things in China were happening, curbing some rare earths. He tweeted, and I have the chart here, that China's been hostile and he wants to put out massive tariffs. Well, the market went down 2.5% to 3.5%. Chinese stocks were down 6%. After market, he announced it was 100% tariffs, giving him time to negotiate, November 1st. So we have a few more weeks. And Xi and Trump were going to meet at the end of the month. Well, it's assuming that, the meeting might be off. Well, end of the weekend, we start hearing that the meeting hasn't been canceled, and the market starts to recover back some of those news. So the market is still reacting to it in the short term, but I think the playbook that you described, which we had it here, we don't need to go through every bit of the playbook, but it's how he negotiates. That you bring in your other members like Besant to soften the message, have them come out and say, well, the meeting's still on. Greer said that yesterday. Meeting looks good. We're going to keep rallying. Well, then China did something, and yesterday we saw a reaction. Trump, I think he looked at it and said, I've already hit them China then hit us back. What's the softest thing I can do to then hit them back to get some more leverage? And he announced that he doesn't want us buying Chinese cooking oil anymore. So there were, of course, jokes on the cooking oil market tanking. Well, it brought down the overall market 60 basis points. So still moving on it, but I think, and we saw this morning, great earnings reports brought the market right back. So short-term noise would really be my conclusion.
I would agree. I do think that there is some long-term macro components that we're going to be dealing with in the long term on how global supply chains are structured and who is vying for dominance in those. So whether Trump is president or not, I think some part of this will always be in there for quite some time as the new world order, I guess, continues to shape out.
It's everything we wanted to cover. We said we think we'll have another good, strong earnings season. Not a lot to report on now, just 5 or 6 good companies in the financial space that look really good. We'll see some headline volatility, but the markets will move past it. And we will see some more in this credit cycle, a few more defaults that are happening, and we think that's normal and not a systemic risk. So thanks for joining us. We'll see you next month.